Welcome back to SMSF Mate's daily podcast. This is our general advice warning that we are required to warn you that any advice has been prepared without taking into account your objectives, financial situations or needs, and because of that, you should, before acting on the advice, consider the appropriateness of the advice having regard to your own objectives, financial services and needs, and where the advice relates to the acquisition or possible acquisition of a financial product, you should obtain a product disclosure statement, PDS, relating to the product and consider the PDS before making any decision about whether to acquire the product. Now let's get into it.
Welcome back to SMSF Mate's podcast. I am in the studio today with
Ashwood,
Gareth,
David. Thanks for coming in, guys, and thanks for joining us. On the phone today, we've got a very special guest. Arjun, you're from InvestorKit, and your business, from what I read online, your property buyers agency, is that correct?
Yeah, so we're a real estate research business and property buyers agency, and we're very data-driven, and that's kind of what gives us the competitive advantage.
Excellent. Can you give us a bit of a rundown of your business, Arjun, and how you sort of see the property market at the moment? Yeah,
so a bit of a rundown on us is, we'll buy properties for clients across sort of residential and commercial property. We're very much data-driven, so it means that we go where the numbers go rather than saying, hey, this is our patch and this is our area. We'll take our clients across the country to find the right investments and help them diversify across markets where we can reduce opportunity cost. And when it comes to our team and the engine room behind it all, we've got various divisions from client success, acquisitions, research, commercial, buyers agency, and portfolio consultants. And so we're a team of 14 and on our way to a team of 20 by the end of this calendar year to really help investors get the best of those different areas when it comes to portfolio strategy, research, and buyers agency.
So Arjun, from a data and research sort of thing, what sort of things is your team looking at when you're looking at property acquisition for a client?
We've got from a data specific, we've got three core areas. One is our macro research, which is mainly fundamentals and going across core areas of people movement, economy, demand, supply, sentiment. And we're trying to break down what really are those core drivers of property that influence it on a macro level. And then we take a deep dive into micro, and this is where we move from what we call influences to indicators. And indicators are just those things that every time markets go down, they show, and every time markets are going up, they show, and every time they're flat, they show. There's never been an event in history where markets are all going up, but all the indicators are bad. So that's one beautiful thing about the indicators. They don't lie. They come to a point of pressure, and whether it's high, low, we can see that. And so that's using things like, throwing a bit of jargon, days on market, vendor discounting, listings, sales volumes, online search interest, building approvals. These are just some to name a few. And then the third and the key part where property differs from some other areas is the third part of research, which is boots on the ground. And this is where we get local understanding, field trips across the country, engaging local specialists, getting a feel for the streets, the patches, the neighborhoods, why some people live on certain parts of the area and why some people prefer other parts. So that's the core three sort of pillars of our research that give us great locations and outperformance.
So what you're saying is don't go and buy an investment property because my mate's got one.
Yeah, the mate might tick one of those points. Maybe be on the ground because they have some good things or things they can share about it. But there's two whole pillars you're missing out with the mate analogy.
Good pickup.
So when people sort of say the liquidity side of things with property, what's your point of view on versus REITs or people investing through property through those structures opposed to direct investment holdings?
Yeah, it's a really good point. I think it's with liquidity and the thought of how that plays into your portfolio. I guess a big part of it is how active you'd like to be and how involved you'd like to be. Where the liquidity helps is definitely how active you want to buy, sell, or look at different opportunities as times arise. And I think that's where a whole bunch of other vehicles probably provide a better opportunity than real estate investing. And then when it comes to someone who'd like to be just, less active and more I've done the hard yards pre-purchase and I'll let time do its thing, is where liquidity doesn't, come up as much of a concern for that type of person. So I think it really depends on how active or less active you want to be. And then that's where you kind of weigh up the liquidity versus the leverage conversation that you have in real estate against other asset classes.
Yep.
And just for the uneducated, a REIT is a real estate investment trust. Anyone want to explain a bit more of that detail?
So it's effectively a fund investing in property, Gareth. So it would be a whole bunch of people putting money together like a managed fund or a unit trust vehicle to invest in real estate.
Yeah, versus buying. Say you've got $1 million property, and you as you're talking about liquidity, you can't sell pieces of it.
No.
That'd be nice.
You could try.
You could try.
But yeah,
maybe to my mate or my parents or something. But the point of a REIT, REIT, is that right?
REIT.
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 Is to break it up, right?
Yep.
Yeah, give people options.
Yep.
Does your organisation InvestorKit, do you focus primarily on residential property, or is it do you do commercial as well? Or
Yeah, so our residential property is the main arm of the business. Probably represents sort of eight out of every 10 transactions. Where the commercial comes in is we tend to work on phases to build portfolios. So we have two types of journeys that we take clients on. One is we work on residentials to build our foundation of properties. And this is also a great way to create a hedge as we go into commercial, because we've got multiple stable residential rental income assets. Easy to fill, easy to find tenants, easy to lend against, easy to get the right leverage. And, comparable sales are all over the place for us to be able to get a fair amount of good sample size to see how things are tracking. So that's kind of how we start most investors' portfolios. And then we get commercial either within the SMSF vehicle or either within certain trusts and things, and it's focused on a high income generation, and the risks that come with it, they're okay to take because, even if they didn't acquire that commercial property, they'd have enough residential properties compounding over time where they'd be okay. So it's kind of like I'll go into this because I'm going to be okay either way, but I'd like for it to work out and I'd like to get the best income out of it, and that's what we're aiming for. And so that's kind of the approach we take on how we look at commercial, rather than just going, everyone and anyone, commercial's the greatest thing, we'll look after you for commercial. We'd rather have, people build up a good solid hedge and foundation, then we add commercial to it.
Nice.
From a rough idea of number of clients, how many clients have got a property in their super fund from your experience, Arjun?
So just over the last 12 months, we've made 217 purchases. Yep. And of the 217 purchases, I'd say, just under a third would have SMSF activity. And the rest of them would be personal trusts, things like that. I find, obviously, SMSF purchases start to come up with those with more mature portfolios, those who have that sort of 200 to 300K funds balance, which is what we commonly see. And then they start to consider some of these broader real estate holdings because they do require that bigger deposits and in comparison to what you'd buy outside of SMSF.
And without giving away your crown jewels, is there particular hotspots where those properties have been purchased? I mean, feel free to just say states or countries or,
countries.
Yeah. Look, I think the interesting thing is if we break up the last 3 years, when we looked at, firstly, markets that we invested in, we actually did an exercise where we took purchases made over these years, did bank valuations, official ones, annualized them to where the valuation time period was not a perfect 12 months, and then compared them against ABS for house price performance in Australia to kind of measure up some of the cities that we thought we'd back and how those purchases have gone. Between the last 3 years, depending on which year you take against ABS data, Australian house price performance, the locations that we picked ranged between 29 to 49% in outperformance. And so when I think of that and I now unpack some of these locations, we had over 21 cities that we invested in across Australia, different time periods. What was unique about 2021, though, just the year that's been, was we had the most cities that were looking across the country to invest in just because how far and wide property markets were performing, especially with some of the markets across regional Australia and capital cities. They were just booming on all angles. So to name a few, you have the likes of Bundaberg, Toowoomba, the Gold Coast, Adelaide, Brisbane, Port Macquarie, Coffs Harbour, Wagga Wagga. The list goes on, but the main thing is there were a lot of locations.
People in Melbourne and Sydney who were under COVID restrictions,
escaping lockdowns.
It was like it sounds like a suburb sheet of no lockdowns.
Yeah, pretty much. I think that definitely aided a lot more flexibility in transaction, and I think the people movement charts show much the same as well. But that aside, I think 2018 was a year where some of our standouts were Bendigo and Ballarat. There was the highest frequency of purchases during that year, and they outperformed many of our cities between 18 to 20. And why I say that timeline in particular is very important to note is this was pre-pandemic, so people can't just go, hey, that was the regional boom, that was people regionally moving over left, right and centre. No, we've always given regional markets their fair share, treat them as individual cities with individual fundamentals. And I think that's the key for investors to outperform moving ahead, is have a greater number of cities under your belt to explore so you can make the decision that's best for you and your portfolio at that time.
Yeah, and from a time frame point of view, I mean, typically a self-managed super fund or super in general is a fairly long-term play rather than a short-term sort of game. And so, do you differentiate with your investment properties from if it's in a self-managed super fund, it may have a 20-year time frame, or if it's in a individual, it might be, or is it case by case kind of basis?
That's actually a really good point you raise, and it's very, very important for that. All good, my man. But it's a very important point you raise because in the personal buying, the criteria is all about outperformance in the short term because investors are confident about real estate long term anyway, and so the short term is used as a way to go. Let me leverage highly, use that leverage to then go across other properties and grow the portfolio. So I have a huge compounding base versus just one asset, buy and hold and sit there long term. So that's the personal mindset. In SMSF, you could get the greatest results in the first year from a residential property perspective, outperform short-term drivers, everything's great, but you can't go in there and start lending and start accessing equity and start, ripping out that leverage and redoing it again. So I think that's really important to note because that means you don't need to go in for that short-term chase or think about those short-term metrics as much. You can just position assets from that long-term view and focus more on that rather than the immediate, sort of opportunity cost point. Unless, of course, you're going to be in your, age groups that need access to super or are looking to access super or sell off super assets or get that income sooner than a, say, 15 to 20-year number. But in most investors' case, if you're in your 30s and 40s and having a 20-year plus outlook, yeah, you've got to focus on the long term, and that short-term metrics don't mean as much in a super fund.
Good answer to my good question.
In terms of personal investment in property versus investment through a super fund, what kind of role does inflation and potentially rising interest rates play in that sort of investment?
It plays a bigger role in the fund than it does on the personal front, just because how far and wide the margins are for investors. Investors can still see interest rates with a 3 in front, even in today's rising rate environment, in their personal names. But this starts jumping into the 5s and potentially even 6s in your self-managed super fund. So that cost margin for an asset that's obviously going to rental yield the same amounts because the property and the property market doesn't care about how you're buying it, that can be huge for investors. And this could be the difference between your contribution going in to hold an asset versus your contribution each year going in to grow your fund so you can invest more. That's something that real estate investors don't take into account as much as they should. Because imagine an investor who maintains a healthier cash flow or buys a more affordable property or puts a bigger deposit down with less debt on there or goes into alternate investments, REITs or funds and managed funds and so forth. I think the key that people don't take into account is that if you're using most of your contributions now to simply just service that property, yes, you're going to have that compounding value of that property. That's great. But your fund won't grow to enable further investments. And that can be a bit of a letdown. And you maybe didn't look into your numbers more holistically. So it's actually a key point to mention that people need to really look deep into those fund cash flows when borrowing and find that sweet spot for them so they can have that combination of I can still hold the assets, so I have less cash in and leveraged returns and long-term gains and eventually see it debt-free. But then I need to also make sure that my whole contributions aren't getting soaked in to just hold this asset up because A, they're going to keep you on principal and interest, and B, the higher interest rates are going to chew away at it. So it's a key point for investors to consider when buying property in SMSF, and if they don't, they could be sitting there with a great asset, they could be sitting there with less cash and power of leverage, but say goodbye to having multiple assets and multiple properties and diversifying within an SMSF as much as you could, just because you're soaking in so much of your contributions into one place.
Yeah, I think that's a really good point because I suppose I was at the point where we bought our house and we still had our old house and the bank let us keep it. But from a personal point of view, I did the stress test of if interest rates went back up to 5 or 6, how much more pressure would that put on the family? And we made the conscious decision that my wife wouldn't go back to work till our youngest was in school. So when you weigh it all up, I think that's a good part to forecast your own personal life, not just on that transactional period of time when you can afford it. Is like Arjun saying, you got to stress test it out, and I think that's a really good point for people to take in mind with real estate because you are taking that long term view, but you don't want to force one partner in the family to go back to work earlier just to fund a property purchase that you made before kids and deal with the fallout personally between you and your partner over that, which can happen because all of a sudden, you just feel like you're working to fund a property that someone else is living in. So it's a different...
Do you think that people do that kind of stress test often? Because
No.
it seems like... Yeah.
Look, it's hard to see people actually look outside that far in the future. I know, mortgage brokers are stress testing your funding capability to a certain extent when they're, producing or when the bank gives you the loan. But I think people also forget the personal cost of working when you have personal circumstances change. And then, I think a lot of potential separations that happen between couples happen on financial terms, and it's just not having the discussion at the start. I think I've said it previously in the podcast here is, me and Jody were very clear when our fixed interest rate comes up, it happens to be the same time as our youngest is in school. And whatever that interest rate is, my wife's going back to work to make up that amount.
Interest per year divided number of hours per week. This is your work commitment.
And that was the honest conversation we had. Now, whether that comes to fruition, I'll let you know in 12 months. But that was the conversation.
So we're doing a marriage counselling podcast in 12 months.
Yeah, well, I feel like I've had the open conversation before we bought the expensive house. So I'm less likely to feel the pushback, hopefully. But we'll see.
I think on the interest rates, it's a really interesting topic because I rarely read the newspaper and was just happened to be waiting for a coffee the other day and flicked through the newspaper and front page was some couple complaining about that they now can't afford to live in some glitzy suburb because the interest rates are now 1.1% instead of 0.9% and the and now in the last 6 months interest rates have gone up 1.5%. They're probably going up another 1% in the next 6 months. Arjun, what's your sort of take on interest rates? Where do you see them going? Maybe short term, long term. What's your thoughts?
Yeah, so this is actually a hot topic at the moment. Interest rates obviously have been, I think, even more important than where they're going and how much it's costing. When we take a look at what our opinion is based on some of the reads we've made on housing fundamentals, we actually just recently, this week actually, released a white paper on Australia's housing fundamentals. And it was a very, very deep review. We did a review and found 25 core housing fundamentals that were across the categories of people movement, economic activity, finance, affordability, supply, and confidence. And as a result, we were giving them rankings from very strong, balanced, weak, and quite weak. And this was to get a really good holistic view of Australia's kind of position on its overall housing fundamentals. So it's more holistic than kind of your fear-mongering articles or your bullish real estate local agent that just never seems to think anything's ever wrong with the market. And so we wanted to look at it overall. And firstly, what we saw was that in the time of property booms, 22 of 25 fundamentals were strong or very strong. However, now that number comes down to about 18 of 25. So if you were to turn up to a test and get 18 to 25, you'd pass the test, right? So I think overall, we're still fairly confident about Australia's position when it comes to housing fundamentals. But no doubt, these interest rates have been one of the weakening points amongst that change from 22 to 18. And what I think is more important is not so much the rise in the cost itself that's pinching households. It's actually the uncertainty of that. The RBA's position and stance was initially, hey, as your guiders and as the controllers of this lever, we're here to tell you 2024, no interest rate rises until then.
Mm-hmm.
Well, that was a load of crap.
Yeah.
And obviously that was not just one component, which is actually it going up earlier, and that 2 years earlier. The second component is how many quick succession changes at how large paces there were. And so I think more important than the actual cost of money impacting families or changing things for people is actually the uncertainty of how far this goes, who to believe, what to do when you don't have any clear sort of expert in your mind because the person or the persons controlling the lever are actually not believable in the first place. So I think the behavior change and impact to sentiment is actually more impactful than the cost of money itself, because having been ex-CBA, we were, we knew the numbers on the back end where people were being stress tested with 20% repayment loading. So if your existing repayments have a $1,000 per month repayment, we would treat that as $1,200. Number two is if you had a 10K credit card limit with the best customer of all time and never used to spend a cent, or you at least always paid it off, we used to assume that you're trying to pay a minimum repayment on a maxed out 10K credit card. When you earned commissions and bonuses and were a top performer and you thought, hey, things are going great, and you'd taken this great commissions, every year you nailed it, well, guess what? We were only taking 80% of it. And then when you were taking interest rates of low loans and 2 and 3 and 4%, there were time periods when we were taking assessment rates of 7, 7.5, and even on the weaker terms, 5.5 to 6. So there's so much inbuilt. And look, that's not even the end of it. Like rental income, you were taking $500 a week. Well, guess what? We were thinking it was $400 a week. So all these factors are there from a very prudent system in Australia. Hence why no matter how many fear-mongering articles come out, as of April 2022, our bank delinquency rates are at 0.7%. The share of non-performing loans in Australia has declined. It's been the lowest level since 2009. So I actually don't think the cost of money is the main concern for Australian households. It's the uncertainty. Who do we believe? How quickly it changed? And that's what's driving down behaviours, vacuuming out the demand in Australia right now for real estate and kind of making it a bit of a pause. So I think what we'll see is that until we get some stabilisation in rates or maybe an overshoot and a turnaround, I just don't think that households are just going to be confident, and that's understandable and believable considering the sudden changes there.
Absolutely. Great answer. It was really interesting you touching on the lending criteria from a obviously experience you've had, because I think a lot of people who apply for their home loans don't necessarily understand how the bank sees them and how they analyze. And I think there's a lot of education that can be given in terms of helping people understand how the bank analyzes their financial position before they go, oh, let's go buy that house and let's just apply for 10 different home loans and have a crack and see if we get it. I think if people actually understood how the maths work and what they are reviewed, it's easier to structure their own finances and positions to suit what the banks, effectively want, right?
With that point you raise, it just also should give a lot of households confidence, right? To go, I know it's kind of annoying that I feel like I'm on such a good income and I can't borrow that much, but hey, the flip side is moments like these aren't going to structurally impact people. They're just going to be a pain or be annoying rather than actually, kill the balance sheets or incomes and of a lot of households. So I think there's the big fortunate part of the upside of all these bank rules and things as well.
Sorry, Arjun, from an assessment point of view of resi versus commercial, what sort of yields would you ballpark a residential property should return to someone after costs? Like when you guys are looking at it, is it what sort of numbers are you looking?
Yeah, so I think when it comes to rental yields and commercial residential, the commercial game is just so much better. It's quite clear when you take into account that typically we're seeing that 5 to 6.5 net on commercial acquisitions, and by net that's after all bills but before mortgage.
Yep. Whereas
in the residential space, like even a healthy $500,000 property, like if you're getting a 4.5% gross yield in a regional location, you take away property management, you take away, council rates, and even a cheaper location, take away maintenance, take away water, and the list goes on, right? Of even a couple of weeks of vacancy, you take away that. All of a sudden you're left with a gross yield of, I'm just doing my maths here, 3.2% net yield from your 4.5 gross. So that sort of 1% you remove off a residential can be a great quick back of the napkin calculation when you take away rates, water, property management, maintenance, and vacancy. And that's where the commercial and residential differs by at least a 2 to 3 net variance in income.
Has there been any change in commercial with greater working from home after the pandemic?
Yeah, I think one thing to notice on the commercial part, actually it's two parts. So number one is on the work from home. There is a sense of belief that immediately offices are just, ghost towns. There is a case of that in some CBD locations, as not many cities, other than say like your Adelaide, have returned to a lot of pre-COVID occupancy. With regards to, offices and the whole work from home movement, what's actually been a bit of a green shoot has been suburban offices. We've seen a lot of businesses start to go, hey, what if I could have that hybrid balance of, having a place to go to in the burbs where me and a few team members are based, and at the same time have cheaper rates of purchase, dollar per square meter, and get bigger space, and still have that commutability from home, work from home, some days go to the office. I think that's obviously been something that's picked up a little bit more. But overall, your retail and some of your offices now have kind of switched, where the commercial cap rates back in the day for industrial used to be the favorite. We'd be getting yields of 6.5 to 7.5, and that was extremely popular from an investing point of view. That popularity's picked up so much that those cap rates have gone right down to 5 to 6.5 for what we would purchase 2 years ago at 7 net. So I think the assets of popularity are definitely more across that logistics industry, and that's kind of where the cap rates have changed. And now I think what's clearly being seen is cap rates across offices and retail look a little bit more attractive. I'm still saying there's a lot of due diligence to be done in that space, because businesses are actively considering other things and adapting to the time, and not everyone who's a business owner could just pack up at 2020 and just change what they wanted to from these last 2 years of COVID. Some would have had leases start in 2019 for 5 years, and they have to stick it out up until that change comes, and they're probably planning their change, and the next 3 or 4 years might start to see some of that change get even stronger. So I don't think this whole work from home was this fad and it only happened once and the lockdown's over and everyone's getting back to normal, everyone comes back to normal. No, I think it's a structural change to stay here with us, and it's just going to be the adaptation rate that will slow down from peak levels and eventually reach a new level that is a new norm, and that new norm will sit much higher than levels pre-COVID because it is a positive impact for many people's lives and businesses as well as customers. So that's kind of our thoughts. So there's been a bit of a switch in cap rates of commercial lens with industrial assets starting to become very, very desired.
Very good. Arjun, we're here today. I think it's the 10th of August. RBA rate was it 1.85%, is it currently? Look around the room.
Let me just consult the Google.
Feel like Albanese.
Better cut that out.
So to your point earlier about currently we have very low mortgage delinquency rates. In the next couple of months, I feel like there's going to be a lot of mortgages that will roll off. They're fixed term, and experience quite a significant jump in probably the 2%, or 2.5% they may have been paying. I think it's up around sort of 4.5% to 5% now for like a 3-year fixed term. So, do you think that we may see the market cool for a little bit simply because like I worked it out the other day? It was something like if you have a $350,000 mortgage and you're essentially coming off, say, what was the fixed rate to the new fixed rate, it
2%.
equates to about, I think it was about $1,600 or $1,700 a month more than what you were paying previously. So that's obviously very significant.
It's probably double the repayment.
Yeah, so
It's a lot of smashed abs on poached eggs.
yeah. So for someone, I mean, $350K is a fairly modest mortgage. To then have to pay $1,600 a month more, like that's significant. I mean, I don't know who would have that spare, right? So, do you think that we may see a bit more pain in the near term based on that alone?
Yeah, it's a good analysis. I think it's clear that we need to all come to an agreement on one part, which is demand cannot operate at the same level sustainably moving forward to what they had in recent years. And the reason for that is there was 22 of 25 fundamentals in a very strong position. And so as a result, all the money in the economy, all the reduced supply, all the lack of money going out to other places, cheap money, all these different things that came into the mix were supercharging prices to a whole new level. And we've got to expect cool off. Like, we just can't operate at, an asset class that produces between 5 and 8% per annum long-term averages should not and cannot operate at 20% per annum plus every year. History has shown us that this is a very rare time. Like what we've seen now, the last time it occurred nationwide was between 2000 and 2005. 20 years. For some people, that's the rest of their investing life if you're 40. For some people, that's 2/3 of your investing life if you're starting to get a decent job and get into investing in your 30s. So the key here is that we got to agree that things will cool off irrespective of rates changes, and with rates, even more so. The second thing is to understand the households of impact. Interest rates rising will definitely, and any sales agent you hear saying it's not going to make an impact to anyone, I call bull. Like, there is always going to be a group of people that will be impacted with any change in housing markets. Now, it's important to rationalize the group of people. I would say last 12 months was one of our biggest years from transaction volumes because of the sheer heat and boom. We would have transacted anywhere between 500 and 600,000 properties in Australia. That's the Australian market overall. But if I'm correct, the number of dwellings in Australia is over 10 million. So there is going to be a 500,000 odd segment of people who transacted in the last 12 months against the 10.6 million dwellings. Those 500,000 people would A, have been at the lowest cycle in Australia's history of interest rates and have seen the sharpest change in terms of percentage of gains that any of us have probably seen in our lifetimes. So that particular group feels pinch and change because they weren't expecting it. They bought at the lowest possible time of interest rates, and they've seen that change. But guess what? There's another part to it. They've also seen upwards of 20% in capital growth over the last 12 months too. Now, yes, there's going to be people who bought in the last 3 months, 2 months, 1 month, 6 months. But that now cuts that 500,000 down to 50,000. So really, is there going to be impact? Yes. But the number of groups that this is contained to, it's fairly limited, because if we now move that dial back from 1 year to 2 years, that 500,000 becomes 1 million transactions. That's now a much better sample size, 10% of households. That million would have seen between 30 to 50% in gains over 2 years. So their deleveraging itself is so big. Yes, deleveraging doesn't mean their repayments have changed, but deleveraging means that in the event that they needed to sell, I don't think the delinquency rates are going to climb up rapidly to a low percentage of affected homes, and also homes with 30 to 50% in gains that could possibly sell it for 5% weaker because the market's lower and still come out okay. Maybe 10% weaker. Anything beyond 10, 15% weaker, we're already in the biggest declines of Australian history. And even then, they're probably still ahead. So I think what we need to look at is to go, yes, there will always be affected households. Yes, there will be cooler markets. It's unsustainable for 20% plus gains to happen on an asset class that's 5 to 8% long-term averages. And yes, buyer behavior is going to act uncertain because of the things that we've just talked about earlier with interest rates changing. But to say 10.6 million residential dwellings that are only going to have 500,000 to 1 million max people who bought in the lowest of history of interest rates have seen a change is suddenly going to topple everything or impact too many people? I don't think so. And if it does impact many people, we're going to see data on a quarterly update on our macro conditions in Australia. And like I assume they will, I think we're going to overshoot because we're going to play the inflation capping off game and follow the rest of the globe and, be using quarterly lag data, and then we're going to pull back. It's just going to be a tool used to say, hey, we're doing really great, and hey, we're not doing so great, reduce. And so I think there's always going to be a small segment of impacted households, but to see it being catastrophic when you break it down to dwellings versus purchases versus gains versus cash and offsets and balances, I think there's going to be a lot of people who'll be fine.
So Arjun, thanks very much. Very insightful podcast today. If anyone does want to sort of get in touch with you or, pay for your services rather than listening to the podcast 10 times over, what's the best way for them to get in touch? Should they contact us or, visit your website?
Mate, the best way would be InvestorKit.com.au. And if you found some of the insights here of value, I think the best thing to check out on their website would be our property market research tab. And we've got that latest white paper I was referring to, which is Australia's housing fundamentals. And you can also use that website to request a free consultation to chat with our team to help you start or scale your investing portfolio.
Excellent. And just remind us, I think you have your own podcast as well. If people go Googling on their Spotify, what should they look for?
Yeah, that's the Property Nerds podcast. And as the name suggests, it's me doing a lot of what I love doing, which is nerding out, chat and research data and numbers. And it will bore a lot of people, but I'm sure there'll be a lot of people that get excited about it too.
and make sure you look at the SMSF Mate podcast first and Arjun second, so we can get Arjun back again. So I think, excellent. Thank you very much.
Cheers, Arjun.
Awesome. I'll catch up soon.
Thank you for joining us once again. If you're interested in our waffle about self-managed super funds, feel free to join us on smsfmate.com.au or search SMSF Mate in Spotify.